Welcome to the Hurst Trading Room Live. My name is David Hickson and today's the 19th of September 2016. Welcome to this, our first webinar of the new season after our long extended break. We took a longer than expected break over summer. We didn't expect it to be quite so long. It's because my travel plans changed. But thank you for your patience and welcome back as we get started in terms of looking at what the markets are doing. As always, before we actually look at the markets, please make sure that you have read and understood these disclaimers. While you're reading the small print, we were chatting just a moment before we started the recording about the earthquake in Italy. And I would like to say a really heartfelt thank you to the many people who emailed us, knowing that, of course, I live in the Le Marche region of Italy, and our head office is in Mogliano, which is in the Le Marche region. And the earthquake that struck Italy at the end of August was in the Le Marche region. It was, in fact, only 50 kilometers away from the town in which I live. And so I want to thank so many of you who sent emails asking whether we are all okay. Luckily, we are. Mogliano is only about 50 kilometers away from where the earthquake struck. But certainly myself and my family and everybody in Mogliano is all fine. There were no injuries or casualties in the town of Mogliano, but it was a devastating occurrence, and many of the properties around us have been really quite badly damaged. Fortunately, my office, which is right in the center of town, in a beautiful, very old building in the hilltop town of Mogliano, the office is still here, as are all my computers. And all my family and the family of the people who work at Sentient Trader are all fine, and we've come through it unscathed. But thank you so much for your kind and considerate emails. It really meant a tremendous amount to me. It's been a wonderful thing as I've built this Hurst Cycles community to actually establish friendships with people who are interested in Hurst Cycles, and that was a demonstration of that. So thank you very much. Let's take a look at the markets. And when I started planning today's webinar, I decided that today I was going to speak about stock markets in the United States and around the world, and I was going to look at gold and oil and the euro to US dollar and all kinds of things in my tremendous enthusiasm to get back into the markets. As I started looking at the sort of finer details of the content and what I was going to speak about, I realized I was looking at about a 5-hour webinar. And so I've made the decision to simplify, which has worked in the past, because as you know, I can tend to go on a bit about cycles in the markets. So I decided to simplify, and I am only going to be focusing on the stock markets today. There are some very interesting things happening in the stock markets, and there's a lot to say about them. So I hope that's okay with you. I'm going to be focusing on the US stock markets, and then I'm also going to take a quick look at the DAX and the FTSE, because there's some interesting pieces of information to be gathered from those markets, and discussions of gold and oil and the euro to US dollar and all the other markets that I hoped to look at will have to wait, I'm afraid, for future webinars. I would like to provide you with some pithy and useful information rather than just rambling on forever and not really ever getting to any point, which can be a tendency of mine. So let's start taking a look at the markets. Here is the S&P 500, and this is a market that, of course, we've been discussing in these webinars ever since I started these live webinars in September of last year. I've looked at this analysis of the S&P 500. The first thing I'd like to do is take a step back and look at the slightly bigger picture. I know many of you are going to be very familiar with this because it's stuff that we've covered in previous webinars, so I'm going to go through it fairly quickly. But I think it's important, particularly when you take a break, as I've done from the markets, you step back and then you come back into those markets. It's useful just to take a step back and see what's happening. So this is what I call the default analysis. I always like to have a default analysis, which is an analysis that I don't really mess with. I let Sentient Trader, the software that performs the analysis, I let it do its thing. I guide it maybe a little bit, but this is effectively the default analysis of the S&P 500. And let me turn on a pen so that I can start doing some squiggles on here. And let's get the right color. There we go. Okay. The important thing about this analysis, and we have discussed it in previous webinars, so I'm not going to dwell on it, but you can see that the really important trough here in 2002 has been phased as a trough of the 9-year cycle. So it's a really big cycle, big magnitude cycle. That's the trough of the 9-year cycle, and possibly even longer cycles. Maybe it was even a trough of the 18-year cycle. We won't discuss that here, but that was a prominent and important cycle trough. The next trough of the 9-year cycle has been placed here in 2011. And I know that many of you will argue with this, and we could have a fascinating debate about it, and we have had debates about this particular analysis in previous webinars. In fact, I did a webinar with Sid from Elliott Wave Predictions, in which he discussed his reasoning for believing that the greater magnitude trough occurred in 2011 as opposed to 2009. Because, of course, if you look at this chart, the most obvious position to place this long cycle trough was here in 2009. So that brings me to the first sort of important point I'd like to make today about Hurst cycles. I'm going to try, because we have many newcomers I know who are joining us for the first time, so I'm going to try, and I hope I'm not going to bore our regular members who've been with us for years, but I'm going to try and sort of cover some of the basics as I speak, so that those who are new to Hurst cycles have some kind of idea of what Hurst cycles analysis is all about. And the first point I'd like to make is that Hurst cycles propose the idea that multiple cycles influence price movements. When you first look at a chart, you notice the really obvious, really big cycle troughs, such as that one over there and this one over here in 2009, and you assume that automatically those really big prominent troughs must be the troughs of the very big prominent cycles. However, because of the way in which cycles combine, that is not necessarily true. As a general principle, I like to keep things simple in my analysis, and so generally I do opt for the simple approach, which is that the really big troughs that you can see there on your chart are indeed the troughs of the very big cycles. But oftentimes the correct analysis is a little more complex than what might seem obvious at first glance. We've discussed this in previous webinars, and if you're interested, please go to YouTube and have a look at our previous webinars. We try to provide a description surrounding each webinar so that you can see what was discussed. And you can find a long webinar that discusses this particular analysis. But the important point is that this is at the moment the default analysis that Sentient Trader performs. Now, I've been performing Hurst cycles analysis for a really long time. I'm going to give away my age. I've been doing this for over 15 years, and but I created Sentient Trader as a tool to help me do it more effectively and quicker and faster. And it's been humbling to discover over the years that Sentient Trader is often a better analyst than I am. And for that reason, I always allow Sentient Trader to perform a default analysis. I just let it do its thing, because very often Sentient Trader turns out to be correct, whereas my attempts to influence the analysis end up sort of damaging it. So this is a default analysis. It's a good analysis, it's a viable analysis. It does, of course, raise a few question marks, such as the low magnitude of the 2009 trough, being a trough of only 18 months. Is that possible? Yes, it's possible. It doesn't contravene any rules. I received an interesting email last week from somebody who's very prominent in Hurst analysis circles, suggesting that the whole 2009 event was an example of a sort of extended fundamental interaction. In other words, things that have nothing to do with cycles were influencing the markets during that time, and that trough should really have been a less prominent trough on our charts. Whether that's true or not, we'll never really know, or perhaps we will know after several years have passed. But the important thing is, what does this mean about what's happening in the markets at the moment? And that's really, of course, the point that I wish to get to. And as you can see here, we had a fairly big trough in February of this year, 11th of February, if memory serves me correctly. And that trough has been marked, according to this analysis, as a trough of the 54-month cycle. That's a 4.5-year cycle. and it is what I call an intermediate 54-month cycle. In other words, it is the trough that occurs between two troughs of the longer cycle. So the longer cycle is the 9-year cycle, and here is the trough of the 9-year cycle according to this analysis. And so we had the 9-year cycle rising up. Then the market came down to the 54-month cycle, the intermediate 54-month cycle, this cycle trough, the trough that happened between the two 9-year cycle troughs. And as you know, cycles form M shapes in markets. Cycles influence prices in such a way that the prices transcribe M shapes in the market, and so our expectation is that the market will bounce like that and form some kind of an M shape. Okay, like a capital M, which means that the market rises to a second peak, and in fact that is exactly what has happened since February of this year. The markets did rise up to another peak. As it happened, that peak was a higher peak in the S&P 500. It hasn't been a higher peak in all stock markets around the world, which is why we're going to take a look at some of those other markets a little later in today's webinar. In Hurst cycles, there isn't any absolute rule as to whether the first peak is going to be higher or the second peak is going to be higher. What you're looking at is whether the longer cycles longer than we have on the analysis, are bullish or bearish. Because if the longer cycles are bullish, that gives us what's called a bullish underlying trend, and therefore the second peak will be higher. So at the moment, the indication would seem to be that our longer cycles, and other cycles longer than we can see on this particular chart, are still bullish because we have seen a higher peak. And let me just zoom in here, and let's just clear these semicircles, and you can see here that we have clearly had a higher peak over here. So here is our M shape starting much lower, coming up to this peak, coming down to the central thing here, coming up to another peak. Was that the peak, or is there going to be another peak? That's really going to be the big question that we're going to tackle today. Are we going to see another higher peak, or is this the peak, the second peak, after which, of course, we expect price to come down and complete the M shape? So that's the situation in the market at the moment, and the fact that we've seen a slightly higher second peak would seem to indicate that the longer cycles are still bullish. They're not very bullish, though, I have to say. We've seen a slightly higher peak, but not a very much higher peak, and so that's an interesting observation, that those longer cycles are still bullish, but there are some worrying signs of weakness that are beginning to show. Let's take a look at another analysis of the S&P 500, which is possibly a more intuitive analysis. And I say it's a more intuitive analysis because here the trough of 2009 is a trough of the 54-month cycle. Now, the 54-month cycle is the longest cycle in this particular analysis, simply because I'm showing the software a slightly different analysis period in order to get it to comfortably position that 54-month cycle trough over there. But the important thing is that the longer cycle has been shifted away from 2011, this trough over here, and it's been placed over there in 2009. Many of you, I think, would feel more comfortable with this analysis, and you'd be thinking that this makes more sense. And indeed it might do. It has a more intuitive feel about it. When you get a deep trough, you expect to see a big magnitude cycle there. So it is a more intuitive analysis. And what does it say about what's happening at the moment in the markets? Well, you can see this trough over here in February of this year has been phased as a trough of the 18-month cycle. Now, that is a little bit questionable, because following that trough that formed in February, we had a really big impressive bounce up to a new high. And in the last 18-month cycle of a 54-month cycle, we would not really expect to be seeing such a strong bounce. We'd expect to see a gradual progression towards bearishness. So this analysis might look better in terms of the 2009 trough, but it doesn't explain as clearly what has happened since January of this year. And when I'm about to make trading decisions, I like to see an analysis that works currently, not an analysis that worked 7 years ago. And that, for me, is a really important point. I want to see something that's really working now. But we're going to come back to this analysis in a moment. The important thing to bear in mind is that perhaps the really big difference between this analysis and the first one is that the trough in February is a trough of only 18-month magnitude, not 54-month magnitude. Now, shortly after the trough in February formed, I started speaking about that trough as being a trough of at least 18-month magnitude. And I know some people find it a little disconcerting that I sometimes tend to be a bit vague about the magnitude of the long cycle troughs. The reason for that is because as an analyst who really focuses on trading the markets instead of just analyzing them, I approach the markets as a trader fundamentally. Of course, I want to be correct with my analysis, but more importantly, I want to be making correct trading decisions. If at the end of the day I look back and it turns out I was completely wrong about the magnitude of a trough, my ego might be a little damaged as an analyst, but the important thing is that hopefully I was making the correct decisions as a trader. And so when you're working with Hurst cycles, I think it's important not to get too worried about the tiny analysis details, and rather focus on looking at the market in terms of your level of confidence in that analysis. And ever since sometime in February, you can look at the webinars in which I've started discussing the concept of the 18-month cycle trough in February of this year. I think it was sometime late in February. Ever since that time, I've spoken of that trough as a trough of at least 18-month magnitude, because that's my level of confidence. I'm confident, I have been confident since February, that is a trough of at least 18-month magnitude. It might also be a trough of 54-month magnitude. All that does in terms of my trading, and I'm speaking about looking at the markets over a period of perhaps a few weeks, which is the sort of period that I like to make these webinars applicable to. So over that sort of period, it's good enough to know that our level of confidence in that trough is that it's a trough of at least 18-month magnitude. But let's see if we can look at a third option. I don't like to look at too many options. The maximum number of analysis options that I will normally consider will be 3. Sometimes I might consider a fourth option, but generally I try to keep it to 3, and I do have a third option for us to consider here, which is the possibility that some short cycles have been at work. Now, what do I mean by that? Well, we work with a thing called a nominal model. A nominal model is really just a fancy term for a list. It's a list of cycles that we expect to influence the price movements of financial markets. And Hurst cycles is unique amongst cycle theories because of the fact that it works with a nominal model, which is a list of cycles that we expect to find. That nominal model is the result of a great deal of research that Hurst originally did in the 1960s and 70s in terms of what the average cycle wavelengths were that were affecting stock markets. When I started working on Sentient Trader, I did a lot of further research, and I discovered an extraordinary thing, which was that the results of my tests came back very similar to Hurst's tests. Of course, I was working with data that went back a really long way, so there was an overlap of data. Perhaps it wasn't really very surprising. When I started focusing just on the most recent sort of 20 years from the 1980s forward, I did notice that there had been some subtle shifts, and that generally the cycles seemed to be slightly different, slightly shorter, but not so much shorter that they dramatically affected the analysis that was being performed. I interpreted that at the time as being simply because of the principle of variation, because cycles vary in wavelength. They stretch, they get longer, and then they get shorter, and they go back and forth. So I create a Sentient Trader with the default nominal model, which is the nominal model that Hurst himself originally defined in the 1970s when he wrote his cycles course, the cyclic cycles course. There's been quite a lot of discussion recently, and we've covered it in some webinars that we did earlier this year in terms of what is the correct nominal model. There's been some very interesting posts written on the Hurst Cycles website about the best nominal model to be working with now, and several analysts agree that the best nominal model to be working with has some shorter cycles in it. I'm not going to bore you with all the details because we have discussed it in previous webinars, but the basic sort of concept is that we're looking at a 7-year cycle as opposed to a 9-year cycle. So you can see the nominal model is slightly shorter, a 42-month cycle instead of a 54-month cycle. So that's working with slightly shorter cycles. Now, when I apply the shorter cycle nominal model onto this chart and perform the analysis, then I get, let me just turn this pen off over here. Let me just ask, I just want to check that everything's still going. Can you all still hear me? Let me know if you're all still there. If somebody can just say, hello, we're still here. My Click webinar platform has given me, oh, you can hear me. Good. Thank you. You were just being very polite. I suddenly had a moment where I thought perhaps everybody disappeared and I was just talking to myself. It's not unusual. Okay, good. So you're hearing me. Thank you very much. Where was I? Yes, so I've applied the shorter nominal model onto this analysis, onto this chart, and as you can see, it actually provides a fairly good analysis. I say, as you can see, perhaps particularly if you're new to Hurst cycles, you're saying, well, I can't see anything, all I can see is semicircles. What do I mean by it provides a good analysis? What I mean is that where there are big troughs in the market, such as there and there are also big troughs in the analysis. It's as simple as that. You know, it's an analysis that makes sense in terms of what's happening. You'll notice that when I apply this shorter nominal model onto the S&P 500, this trough in February of 2016 is now phased as a trough of the 9-year cycle. So we have 3 analyses here, and fundamentally they differ at this sort of level of detail. They differ in terms of the magnitude of the trough in February of 2016. I still consider that trough as being a trough of at least 18-month magnitude. Personally, I think it's really very likely that that was a trough of about 4.5 year, 54-month magnitude. I'm not sure about it being a trough of the 9-year cycle, to be honest, but that idea is out there and you can think about it and work with it. Let's now discuss some other details about this analysis, and I hope to eventually get to the point where we can say, okay, this is what we're expecting to happen now. This is where we are now, and provide a little bit of a roadmap for what we should be expecting. So that's those are the 3 analyses that I'm going to sort of start discussing in a little more detail. Let's go back to the first one, the default one. As I've pointed out, the only really big difference at the bigger scale is that the magnitude of the trough in February of this year changes slightly. Now let's bring something else to the party, or to the consideration, and that is a consideration of the peaks. As you know, in the new version of Sentient Trader, if I can find the right menu, we can perform a dual analysis. That means we're analyzing troughs and we're also analyzing peaks. Those analyses are not connected to each other. They're not actually related to each other. Sentient Trader does not perform a trough analysis and then figure out where the peaks are. What it does is it performs a trough analysis and then separately it performs a peak analysis. I did a webinar all about that, so I'm sure that you're all fairly familiar with that. The first thing to say about this is that this is a new concept in terms of Hurst cycles, working with the dual analysis. It's something that I've been doing for some time actually, and perhaps I should provide a little bit of history, particularly for those of you who are joining us new, and I know that many of you today are newcomers to Hurst cycles, so I don't want to frighten you away with concepts that you just don't even know what I'm speaking about. So let me provide a little bit of background. Hurst, when he originally published his work, spoke about how the cycles which influence the price movements of stock markets have synchronized troughs. What does that mean? Well, we've got multiple cycles, as I've mentioned, a nominal model or a list of cycles that we expect to find influencing the price movements of a financial market. And the principle of synchronicity tells us that the troughs are synchronized where possible. Why where possible? Well, we have a 40-day cycle trough and we have an 80-day cycle trough. Now, it's impossible for every trough of the 40-day cycle to be synchronized with the trough of the 80-day cycle, obviously, because the 80-day cycle has double the wavelength of the 40-day cycle. So not all of those troughs can be synchronized. That is what the words wherever possible mean. It's not possible for every single trough to be synchronized. But where possible, the troughs are synchronized. That's a very important principle of Hurst cycles. Now, when I started working with Hurst cycles, I did a lot of analysis of gold. I'm South African, and gold stocks were of great interest to me, and of course the price of gold was of great interest to me. I analyzed gold and noticed that the troughs really didn't seem to be very well synchronized. What seemed to be synchronized were the peaks. And in some work that I did with Ray Tomes, who's based in New Zealand and has a fascinating cyclic theory called the harmonics theory, Ray Tomes explained to me why commodities and precious metals most probably have synchronized peaks as opposed to synchronized troughs. And it has to do with the relative emotions involved between the stock market and precious metals, for instance. Precious metals are often seen as safe havens. So when people are panicking about the state of the economy, the stock market is dropping into a trough, and the price of gold, generally or often, is sort of rising, or people are moving into gold. Emotions surrounding the peak of a gold price are very different to the emotions that surround the peak of a stock market price. So that is why I believe that commodities and gold are best analyzed with synchronized peaks. That's when I started doing it. And if you're interested, take a look at a price of coffee, for instance. Coffee has fantastically sharp, isolated peaks, very rounded, clustered troughs, just the opposite of what you expect to see in a stock market. A stock market generally has sharp, isolated troughs and rounded, clustered peaks. I think you can see that even here on this chart. I'll just spend a moment. Here's a sharp, isolated trough in 2009, and here's a double, slightly rounded, slightly clustered peak. Here's another rounded, clustered peak. Here's a rounded, clustered peak that we saw last year. Perhaps this year we're going to see another rounded, clustered peak. Anyway, that was really a little bit of a diversion. The point is that I was introduced to the concept that you could also analyze markets on the basis of peaks being synchronized. Now, generally, when you're looking at a stock market, you expect the troughs to be synchronized, but not the peaks. But because Sentient Trader has the ability now to perform a dual analysis, I find it really interesting to do that. And I look at the analysis of the peaks. Generally, I should point out, I expect the analysis of the peaks to not be very good. And again, what do I mean by not a very good analysis? Well, here I've got a strong peak, which is indeed a good peak in the analysis. But here I've got a peak of 54-month magnitude in the analysis, and there's the peak. It wasn't a really very strong peak, was it? Here I've got a really strong peak in price, and that's only an 18-month peak in the analysis. Here I've got a 9-year cycle peak in the analysis, and here's a pretty mediocre peak in price. And that's because, in my opinion, in fact the cycles are synchronized according to their troughs, or the troughs are synchronized in a stock market, and the peaks are not synchronized. So the result is we get not a very good analysis in terms of the peaks. Nevertheless, it adds some value, as I'm going to show in just a moment, because being able to analyze the peaks gives us extra information and tells us what we can be expecting in terms of when the market's going to peak and how that's likely to happen. Let's take a look at the peaks on the other two charts, and we'll discuss differences before we zoom in and take a look at what's happening now. I see a comment from Nathan, 2020, showing peak and trough nearly the same period. Yes, and in fact that's going to have to be the subject of a separate webinar, Nathan. For as long as I've been doing these dual analyses, you end up with this situation, and it happens all the time, particularly intraday. And that's going to have to be the subject of a separate webinar. But what you often find happening is that those semicircles, or the circles and whiskers, indicate a very, very close together periods for peaks and troughs to form in the market, which provides us with a really interesting sort of a dilemma. It's a fascinating thing, and in fact, I have a theory about it. I'm going to give myself 60 seconds to speak about this. Hurst cycles, when you analyze the markets, I believe that life works, or the markets work, in such a way that you can only see a certain distance into the future. And the further you look into the future, just the way in which the markets work, the more impossible it becomes to determine what's actually going to happen. And you'll find this happening time and time again when you perform an analysis. You've got, of course, 100% hindsight. You can look at the past and you can say, I know what happened there now with 100% clarity, or perhaps not 100%, 80% clarity. As you look at tomorrow, your confidence in what's going to happen drops away. And I think it is the nature of the way in which markets work that the further you move into the future, you end up with a paradoxical situation. And it happens time and time again, and Nathan spotted it here, a simultaneous peak and trough of the 9-year cycle. In my opinion, that's an indication of how, as we look further ahead into the future, it becomes impossible for us to know what is actually going to happen. The other thing that it does warn of, as a matter of interest, is it warns of very, very strong market action. Whether that action is down or up depends on whether the peak or the trough occur first. If the peak occurs first, which is quite possible under this scenario, then we're going to look at a very strong, very, very nasty move down following that. Anyway, that was a little bit of a digression. Let's take a look at our second analysis, which has the 2009 trough as a 54-month cycle trough. And let's look at our peak analysis here. And the interesting thing about this peak analysis is that it is, in fact, very similar, not quite identical, but very similar to the analysis we've just been looking at, with a very big cycle trough, the 54-month cycle trough here in, was that May of last year, and it's telling us that the market's coming up to an 18-month cycle peak over here. So there's very little difference. So I'm going to come back to these analyses in a moment, and we'll cycle through them. The third analysis that we have is our short cycle analysis, where we're working with a shorter nominal model. In other words, the list of cycles, each one of our cycles is slightly shorter than the nominal model that Hurst actually defined. And if we look at our peak analysis here, something very interesting happens. Do you notice how good that peak analysis is using our shorter nominal model? Here, our peak analysis actually looks really good. Can you see there's a peak and a strong peak in the analysis? Peak in the analysis, strong peak in the market. And now our 9-year cycle peak, according to this analysis, occurred last year in May. Okay, so this is a very interesting thing that this shorter nominal model provides us with. It provides us with a much better analysis of the peaks. And one of the ways in which I like to consider the validity of an analysis, or how good it is I plot these semicircles, and I look at how even these semicircles are. When you get semicircles that are sort of perfectly in line with each other, that is a perfectly symmetrical analysis, which is often, not always, but is often a very good indication of a good analysis. And you can see we've got very even red cycles, the 9-year cycles, very even 54-month cycles, the 4.5-year cycles, and the 18-month cycles. So for all of you who have Sentient Trader, that might be something really worth investigating. And nowadays with Sentient Trader, you can work with different nominal models in your peaks and in your troughs. And it's an interesting idea that I'm just beginning to explore, the concept of working with a shorter nominal model in terms of the peaks, and working with the standard nominal model in terms of the troughs. So that's something that you can all go off and have fun doing. And I think it's revealing some really quite interesting things. Now, let's zoom in. Let's sort of, having considered what's happening on the longer time frame, let's just bang right in here and start taking a look at these analyses in the most recent time frame and discuss what it seems likely is going to happen now. First of all, here's our default analysis. And if I just squash that up a little bit, of course, just as a reminder, our default analysis has a 54-month cycle trough here in February of 2016. And what has happened since then is, as you can see, let me just zoom in here. What's happened since then is that we have had a 20-week cycle trough that formed over here at the end of June. Now, I'd like to point out something about that 20-week cycle trough. The nominal length, which is the average length of the 20-week cycle that Hurst defined in the 1970s in his cyclic cycles course. He defined a different nominal model as a matter of interest in the Profit Magic of Stock Transaction Timing book. And then the cyclic cycles course, which he published about 2 years later, I think I'm correct in saying, had a slightly different nominal model. So I've always regarded that as being the correct nominal model, because presumably he had additional research that he based that nominal model upon. Anyway, the average length of the 20-week cycle in the cyclic cycles course is 136 days. Now, the number of days from the February trough until the end of June trough was, I think you can see there if you have really good eyes, was 137 days. 137 bars and days, and that is 1 day longer than the average length of the 20-week cycle that Hurst defined in the 1970s. So when something like that happens, it gives me warm fuzzy feelings, because when you get a cycle, or when you get a trough forming that is so close to the average length that was defined 40 years ago, it has to have some meaning, in my opinion. So I'm really confident about that placement of the 20-week cycle trough. We could debate it, and in earlier webinars, in fact, in the webinars in sort of May and early June, I spent some time debating the possibility that this was a 20-week cycle trough over here in the middle of May. But with the benefit of hindsight, we can see a much better 20-week cycle trough. So I think that's really good. And as Derek says, there was good buying there. There was very good buying there. You had to be really quick. It was very quick, and of course it was tied in with Brexit. And so I did a whole webinar pretty much about Brexit and how it affected the FTSE, and I'd like to show you the FTSE in a few minutes, and we can take a look at the FTSE and see how that happened. But that move was in the aftermath of the Brexit vote. Now, the aftermath of any news event is often a really good time to make some profitable trades, because news events, as you know, I've expressed this opinion many times before, news events don't move markets, but they create tremendous volatility. It's not my idea. Many people share that opinion. Notably, Robert Prechter of Elliott Wave International is constantly stating that news events don't move financial markets, but they do cause tremendous volatility. And what they tend to do is they move markets away from where they were busy going, and you get in after the news event and you just ride the move back to where the markets were meant to be. Anyway, that's a really interesting trough there at 137 days. I think it's really nice as a 20-week cycle trough. Let's just quickly have a look at what's happening with the peaks, because the peaks are not as important, but it's really quite useful to keep them in mind when we're going to start making trading decisions. The first important point to make about all of these peak analyses is that the peak that has been marked here as being the prominent peak, or the big magnitude peak, is the peak in May of last year. Now, of course, it could be that this analysis is wrong, and that wasn't really the big peak. But I'm inclined to believe that probably was a really big, important peak. Why have the markets come up to another peak, to a second peak? Well, we know that, of course, M's have two peaks, right? And in the markets, one or other of them could be the highest peak. I think we've seen an interesting distortion, particularly in the American markets, which have achieved new highs. And that distortion has to do with all kinds of things. I'm not a conspiracy theorist, I must say that. I don't believe people are out there manipulating the markets, but market moves do get distorted by emotion, and particularly when you've got powerful governments and very big, powerful companies involved in the markets, which of course they are, then you get distortions, and they might not be sinister manipulations, but the market tends to get distorted. And I believe that we might have witnessed a little bit of a distortion, and I'm very comfortable with the fact that the really big peak really probably did occur last May. I'm sticking my neck out a bit with that because not many people would agree with me, but I think that May peak of last year is a really important one. Of course, we've seen a new peak now happening in August of this year. We saw another peak, and some people might argue maybe that's the really big peak, but I'm keeping my eye on that May peak. The fact that I think that the May peak over here was possibly or probably the really important peak, does that mean that we're not going to see new highs? No, not necessarily. Hurst cycles analysis differs from an Elliott wave approach, where you have very clear rules. The price cannot exceed the region of the wave one or something. My Elliott wave rules are a little vague. Sorry about that. But Elliott wave has clear rules which sort of rule out an alternative analysis. Hurst cycles aren't quite the same. We could continue to see higher peaks, but nevertheless, the 54-month cycle or even 9-year cycle peak might very well have occurred last year. I hope that makes sense to you. The important thing is to focus on the rhythm of the market and what we're seeing unfold. And so for that reason, let's zoom in and have a look at what has been happening according to this analysis. Now, according to this analysis, we had an 18-month cycle peak which formed over here in about the middle of August. And I think it was David who I see has just made a comment. You agree to take into account commonality with the European markets. Yes, and I do hope to get to the European markets in just a few minutes and show you the commonality with the European markets. And I believe David at Trading Hurst tweeted about the upcoming 18-month cycle peak to expect in the markets, and certainly it seems very likely that 18-month cycle peak formed sometime in August. So what does this mean in terms of what we can expect to happen now? Well, the first thing to be said about what's happening now is that the Fed are having a big meeting this week. Tuesday and Wednesday, I think they're meeting, and everybody's expecting that the Fed announcement is going to change the course of the markets. As you know, and as I've already mentioned just a few minutes ago, I don't believe that news events or Fed announcements change the course of the market, but they do create volatility. And news events are often the triggers that the markets need to actually fulfill their cyclic destiny. That sounds slightly abstract, I know, but it's the way that I tend to look at things. The markets, always do what the cycles indicate they should really have been doing, because we're able to look back with hindsight and see those cycles there. But they often do it in slightly unexpected or unusual ways, and news events often provide the triggers for those things to happen. So, bearing in mind that there is a Fed announcement coming later this week, what do we really expect to happen? Let me zoom in a little more and let's start looking at some of these details. First of all, what's happening in terms of our troughs? Well, we're looking for an 80-day cycle trough, as you can see over here. Here's the nest of lows, and it's leaning over to the left. which means that it's slightly overdue. So we're expecting an 80-day cycle trough to form in the markets. So one possible thing that might be happening is that the market is trying to bounce out of an 80-day cycle trough, but is simply not succeeding. What that Fed announcement might do this week is it might provide the trigger for us to get a big bounce. What's the peak situation? Well, we're looking for a rise up into a 40-day cycle peak. A 40-day cycle peak is nevertheless a fairly important peak. And so, we are looking at getting a bit of a kick up into that 40-day cycle, and maybe the Fed announcement will provide that kick up into there. As I've mentioned, news events often cause volatility, and then the market turns around again. I wouldn't be surprised to see a kick up, the formation of the 40-day cycle trough, and then a continued move down. But before we start saying that the 80-day cycle trough definitely formed over there, I'd like to show you something else on this chart. Let's just zoom back a little bit. We spent a lot of time earlier in this year in the webinars speaking about the concept of a dominant cycle. A dominant cycle is the cycle that is most powerful in the market, and it's the most visually apparent cycle. In other words, you can look at it and you can see it. And so if you were a newcomer to cycles and you're trying to identify cycles, you could probably say, well, the cycle went up there and down there. I can see that cycle, right, up and down. And that, of course, is the 20-week cycle. So it looks as if though we had a fairly dominant 20-week cycle. But the jury's still out on that. What actually might have been happening is that we have a dominant 40-week cycle where we get a move up to this peak here, and now we're going to get a move down. So it's important for us to bear in mind that there might be a dominant 40-week cycle. A dominant 40-week cycle means that we've seen a clear move up. Let me just clear these scribbles. We've seen a clear move up. Yes, we have. There was a little bit of downward movement, but it was more of a sideways movement, really, as opposed to a downwards movement. So we've seen our upwards move for the 40-week cycle up to this 18-month cycle peak. And now the next move that the cycles need to give us is the move down into the 40-week cycle trough. And if the 40-week cycle is dominant, that's likely to be a powerful move. And let me just zoom out a little bit so we can see when that 40-week cycle trough is expected. And there we go. Here you can see the nest of lows. It's not a very neat nest of lows, but here is the 40-week cycle trough nest of lows over there. So we're looking at a 40-week cycle trough forming sometime in probably October or November. So if the 40-week cycle is dominant, then that is what we're going to see. We're going to see a strong move down into the 40-week cycle trough. Now, again, before you start saying, oh, okay, so now the markets are definitely moving down, let me point out that we don't yet know that the 40-week cycle is dominant. What if the 18-month cycle is dominant? And that is still possible. And we need to, as analysts, be responsible and consider all possibilities. So if the 18-month cycle is the cycle that turns out to be dominant, then what we would expect to see, turn on the pen again, is a move up for the 18-month cycle followed by a move down. So in fact the move down is only going to come as price moves down into this 18-month cycle nest of lows in about May or June of next year. Okay, so again we have sort of three possibilities. Let's speak through them in slightly more detail and see if we can draw any conclusions about them. First of all, what about the possibility that the market is now bouncing out of the 80-day cycle trough, which is overdue, as I mentioned, the first possibility, where I mentioned that, in fact, we'd expect price to bounce out of the 80-day cycle trough into the 40-day cycle peak, and that's going to be our next move. That's an upwards move. Okay, how do we feel about the 80-day cycle? Well, when considering cycles, I like to look at the previous cycles. So let's look at the previous 80-day cycles. And here is the cycle move up, down to a trough over here. And, and then we had that move there. Those aren't clear cycles. Can you see that? I mean, each cycle you expect to have an up move and a down move. and then an up move, and then a down move, tracing out an M shape. We do not have those clear up and down moves. What does that mean? It doesn't mean that the 80-day cycle disappeared. It meant that it was overpowered by a longer dominant cycle. As I've mentioned, either the 20-week cycle, which was fairly dominant. We do get a fairly clear, I've turned my pen off. We do get a fairly clear move up, and then a not very clear move down, but we get a bit of a move up and a move down, a fairly dominant 20-week cycle. It's more likely that the 40-week cycle is dominant, and I know that William, I'm not sure if William's with us today, but William pointed out in webinars we did before summer that he pointed out that his spectral analysis work indicated that the 40-week cycle was probably dominant. I'm not sure whether that is still the case. But certainly the 80-day cycle was not dominant. So when an 80-day cycle has not been dominant, it might, of course, come back into dominance. But you shouldn't hold your breath or bank all your money on the fact that the 80-day cycle is going to suddenly become dominant again. So with bearing that in mind, let's have a look at this sort of most recent period over here and ask ourselves whether the 80-day cycle trough possibly formed last week, or whether it still lies or whether it has formed already, or whether it still lies ahead of us. First of all, an 80-day cycle is 68 days in average length. So I like to always measure 68 days. And I end up over here. That looks like a weekend. That was the weekend of the 3rd of September. That would have been a perfectly average length for our 80-day cycle. Then if we look at the bottom right-hand edge of the chart, you can see the recent length of the 80-day cycle has been 55 or 56 days. Here is 55 or 56 days, where of course the circle is. And so possibly an 80-day cycle trough occurred over there. Now the markets have, let me just clear that, the markets have been in a very long sort of flat period, during which time it's very difficult to identify cycle troughs. It's important to remember that cycle troughs did still form in there, but they're probably very subtle ones. I've got to tell you, I think the chances are fairly good that the 80-day cycle has already formed. I wouldn't be surprised if that 80-day cycle formed here, what's that, on about the 1st of September. I wouldn't be surprised if, with the benefit of hindsight, that's where the 80-day cycle trough did actually form. So what does that mean about what I'm expecting now? I mentioned that we've got an 80-day cycle circle and whiskers, but I'm not going to bet the bank on the fact that price is going to bounce out of an 80-day cycle trough. I think we're definitely going to get a bit of a kick up into this 40-day cycle peak, but I wouldn't be surprised if, in fact, what's happening in terms of the troughs is that we'll get a move up into the 40-day cycle peak, followed by a move down into the 40-week cycle trough. And so, in fact, the next move that I'm really focusing on is not going to be this kick up. And of course, I might end up missing out on a great trade as prices kick up to new highs. Indeed, they might get up to new highs. But in my opinion, the next important move is going to be the move, I've turned on the wrong pen, let me turn that off, is going to be the move down into this 40-week cycle trough over here. So I'm going to be watching that. Let's take a look at our other analyses and see whether they provide us with any clearer pictures or some better ideas in terms of what's happening. So we'll do the same thing and zoom in just on the most recent time period and see what is actually happening here. You can see, according to this analysis, which has only an 18-month cycle trough here in February, we also have an overdue 80-day cycle trough, which was expected over there, and I've pinned this 20-week cycle peak over here just to play devil's advocate to see whether it is possible that we're going to get another big move up. Now, there's an interesting formation that has developed over here. These circles are really powerful. They tell us when the next peak or trough of a particular cycle is expected, and there we have an 18-month cycle peak. I pay attention to those peaks when I see them. And that 18-month cycle peak occurred on the 25th of August, and the actual peak that occurred here in August was on the 15th of August, so only 10 days earlier. A 10-day discrepancy on an 18-month cycle doesn't necessarily mean that is definitely the 18-month cycle peak, but it's well worth considering the fact that that 18-month cycle peak has happened, and therefore the first analysis that we looked at in terms of peaks was more probably the correct one. Nevertheless, I'm keeping an eye on this analysis because it is possible that the markets will break up into higher highs, and it might be that with the benefit of hindsight we'll look back and we'll see that the 18-month cycle peak has formed. The important point really, in my opinion, is yes, we might see another high, and we might see price coming up, forming another high. But the really important thing is that the next significant move that I believe is going to happen in the market is going to be a downwards move, dropping down into this 40-week cycle trough. Now, there's a new tool that Sentient Trader has called the composite model line. The composite model is the result of combining all of the cycle information and reconstituting price movement as a result of that cycle information. You have to be quite careful not to regard it as a magic forecasting line, because it's not. All it's doing is it's taking the cycle information that you have and it's presenting it to you. So let's have a look at these two analyses that we've discussed and see what the composite model line tells us about them. Let's go back first of all to the default analysis, and let me display the composite model line. There is the composite model line. Now remember, this is just taking all the information that the software has about the analysis that it has performed, and it's combining it into this line. It's a matter of interest. You can see here the cycles that I've selected. I've included sigma L and the 9-year all the way down to the 20-day cycle. Okay, including troughs and peaks in terms of generating this composite model line. So now, what's the next big move that the composite model line is telling us to expect? It is this downward move into the 40-week cycle trough. Okay, why, with this 80-day cycle trough over here, does the composite model line not give us more of a bounce? Why isn't there a big bounce there for the 80-day cycle after it forms its trough there? The reason is because, according to the calculations that the software has performed, in terms of the recent amplitude of the 80-day cycle, the recent amplitude of the 80-day cycle has pretty much fallen away. And that's what we're doing when we look at a chart visually and say that, the 80-day cycle just isn't very dominant. There isn't a move down into the 80-day cycle. I mean, this 80-day cycle trough was right up here, right at the top of price. So the amplitude of the 80-day cycle recently has been very, very low. What has been moving the markets have been the other cycles, and certainly not the 80-day cycle. So the software makes the assumption that the amplitude of the 80-day cycle is going to remain the same, which is a flawed assumption, because we know that the amplitude of the cycles will vary thanks to the principle of variation. But it is better to make the assumption that the cycle will remain the same than to make a potentially even more flawed assumption that they're going to change one way or the other. So currently the 80-day cycle amplitude is running really very low, and that is why the composite model line shows us no bounce out of this trough. But remember, this is not a magical line. It's not using information that has been drawn out of the ether that can't be found elsewhere. So it's based on this analysis that it has in front of it. If we show the software a different analysis, then you will get a different composite model line. So let's do that, and let's go to our other analysis and let's display the composite model line for this analysis. Now this analysis, and remember, this analysis is the one where I pinned this 20-week cycle peak over here, forcing the software to make the assumption that the 18-month cycle peak has not yet occurred, despite the fact that it looks quite likely. So this composite model line, on the basis of this analysis, shows us a move up into the 18-month cycle peak. We need to be aware that that is a possibility. But frankly, it's a fairly short move up. and then the markets are going to drop out of an 18-month cycle peak. So if this analysis turns out to be the correct one, the move that personally I am going to be interested in trading is not really going to be this short little bounce up. In terms of my longer sort of swing trading, not my intraday trading, of course, I will hope to ride that trade upwards on an intraday basis. But in terms of a slightly longer term perspective, I would watch the market coming up to this peak, and it is this move here for the move down into the 40-week cycle trough that I would expect to provide me with a stronger and a more profitable move. So that's what I think the cycles are saying in terms of what is about to happen. I prefer not to say absolutely we're not going to see new highs, or absolutely we are. I think it's very possible we will see new highs. New highs would not negate or annul either of these analyses that I've shown you, or any one of the three analyses that I've shown you. So the possibility of new highs is there, and indeed you could make a profitable trade as the markets move up into those new highs. But I think we need to stand by and look for this move down. Now, what if the 40-week cycle is not actually dominant, and it is the 18-month cycle that is dominant? Well, if that is the case, then this move down that we see here presented quite prominently on the chart, that move down will not be so much as a move down as a sideways movement. So if that starts happening, and if we see a move up to new highs and then a sideways movement, we will of course be doing webinars again, and we'll be discussing this as it happens. But if we see a sideways movement playing out, or the move upwards is stronger than expected, then I would say, well, we clearly have an 18-month cycle which is dominant, and therefore the move down is going to be delayed, and we're going to be looking at a move down into next year, as I showed you on a chart a little bit previously. I won't show you that again, because what I would like to do now is take a quick look at the European markets, just to provide us with a slightly different perspective. And I'm not going to give you the whole story all over again for these markets. This is an analysis of the DAX, and as you can see, the analysis of the DAX also has a 54-month cycle trough there in February of this year, and it has an 18-month cycle peak over here in August. Okay. In fact, let me just zoom out a little bit so that we can see the big peak of last year, and you can see that according to this analysis, let me just zoom all the way out and then zoom in. This is going to be the easy way of doing it instead of sort of stepping through it. There we go. Okay, and if I display the semicircles, you can see that this analysis has a peak analysis that is really not very good. It doesn't fit very well. And the reason for that is because the trough analysis, as I've mentioned, in stock markets generally works much better. I'm planning to do a little bit of experimentation on the DAX in terms of working with a shorter nominal model in the peaks. I think that's going to be very interesting. So I hope to come back at our next webinar, or at least our next webinar, where we can discuss the DAX and show you that. But let's go back to the near term and discuss what is most probably happening here. Here we have a much clearer indication that we have an 18-month cycle peak over here. We've already seen a good, fairly strong move down into the 80-day cycle trough. I expect the DAX to bounce at this point out of the 80-day cycle trough, and it's probably going to go up to the 80-day cycle peak over here sometime in October. But where is our big circle and whiskers? Oh, I see David has said goodbye. Thank you, David. See you next time. Here's our big circle and whiskers for the 40-week cycle trough. So, of course, I'm expecting a bounce out of the 80-day cycle trough into the 80-day cycle peak, and then a move down into the 40-week cycle trough. I hope you can see how these analyses are beginning to all tell the same story. They're saying that we're expecting a bit of a bounce now, And I wouldn't be surprised if the Fed announcement provides the trigger for a bit of a bounce, but you need to be careful. Maybe the bounce will actually have played itself out before the Fed makes its announcement, in which case the Fed announcement will provide the trigger for the reversal and the turn downwards. So you have to be very careful when news announcements are about to be made. But the important thing is I'm expecting a bit of a bounce followed by a move down. Let's see if I have a composite model line here and see what that composite model line is telling me to expect. There we go. Oh, I've turned it off. There it is there. You can see the composite model line is saying that the combined amplitude of all of these cycles is really giving us a strong move down into the 40-week cycle trough. Okay, and that's probably because it has conflicting amplitude information about the shorter cycles, which is why the composite model line has been reduced to kind of a flat line move, if you like. It's because you must remember the composite model line is simply combining the information that it has about the cycles. And finally, let's take a look at the FTSE and see what the FTSE has to say. Here again we have a very similar situation. We've got an 18-month cycle trough here in February. We've got an 18-month cycle peak over here in August. We have the 20-week cycle trough at around about the time of Brexit. You might argue that actually, correctly speaking, that trough should be set a week earlier, but nevertheless it forms a good trough for us on our analysis. And here you can see a very nice, neat 80-day cycle trough. So we're definitely expecting a bounce out of the 80-day cycle trough at the moment. Again, we've got a nice nest of highs for the 80-day cycle peak over there, and we've got a 40-week cycle trough over there. So this chart really summarizes fairly neatly and clearly what I would say I'm expecting from the markets, which is a bit of a bounce up at the moment, a peak within the next month or so over here. Whether it's a higher peak or not could be debated, and then we're going to see a good strong move down, and that strong move down is really the move that I think is going to be the most interesting move to trade, depending of course on your time frame. If you're trading the market on 15-minute charts, then you're going to have lots of opportunities to trade before that strong move down. And that brings to a close my summary of what I believe is happening in the markets at the moment. I'd be a little careful around the news announcement that the Fed is going to make in the middle of this week, unless you happen to be one of those people who trades news announcements. I've met a few of you, nerves of steel, trading news announcements. But if you aren't somebody who trades news announcements, then be careful of those news announcements. A lot of volatility. And I would certainly be looking for a bit of a move up over the short term, but then it's going to be the move down into the 40-week cycle trough that I think is going to be really interesting. So as always, thank you very much for your interest in Hurst cycles. Thank you for joining me today. I look forward to seeing you in our next webinar. We are getting back to our same rhythm of a webinar every 2 weeks. I will see you all in 2 weeks' time. If you are a Sentient Trader user, I will see you before that. I hope we have some exciting news for Sentient Trader users, and we're going to be doing a webinar within the next 2 weeks. So I look forward to seeing all of you before that. But for everyone else, I look forward to seeing you in 2 weeks' time. Thank you so much for your interest in Hurst Cycles and in Sentient Trader, and I wish you profitable trading. And thank you for your time and for joining me.